Hello, this lecture is on IAS 7 Statement of Cash Flow with focus on Consolidated Statement of Cash Flow. Now, take note that we are not just doing IAS 7. We are not just learning about Statement of Cash Flow. We have done that already. So it will be a quick revision and reminder of what we know under IAS 7. But at this stage, our interest is in consolidated statement of cash flows as part of IAS 1 requirement for listed entities, mandated entities that prepare their financial statement under IFRS, International Financial Reporting Standards. So that's what we are looking at right now. At the end of this, from your revision and everything we are going to do, you should be able to explain the difference between profit and cash flows. We all know as accounting students that there is a difference between profit and cash flow. To explain the value of statement of cash flow to users of financial statements, why the need for entities to prepare statement of cash flows, how does users benefit from statement of cash flow. To calculate cash flows from operating activities, so you know there are three main headings in terms of how the format for presentation. Cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. So you need to learn how to calculate cash flows under these three headings. To prepare a full statement of cash flow is fact. To prepare a full consolidated statement of cash flow. And every standard has disclosure requirements. So, as you already know from your previous learning, entities need to present historical changes in cash and cash equivalents. So this is the standard IAS 7, then prescribes the format for presentation. And it is part of the requirement of IAS 1. IAS 1, when you answer the question, what are the components of an entity's financial statement? The components. You have statement of profit or loss, statement of other comprehensive income, statement of changes in equity, statement of financial position, and statement of cash flow. So it's just one of the statements that need to be presented by entities that prepare their financial statements under the rules of IFRS. Now, so all entities that prepare financial statements in conformity with IFRS are required to present a statement of cash flows. Let's define some few things which you already know. Cash is cash on hand and demand deposit. It also includes overdraft. So if you have a bank overdraft, it's part of your cash. Cash equivalents are short-term, highly liquid investments, readily convertible to known amounts of cash, subject to insignificant risk. Short-term investments, readily convertible, which means you know the amount you will get, and even if it will be different from what is in your books, the risk of change in value is insignificant. Example is investments that you hold that are less than 3 months, 3 months or less, those kind of investment. But investment in equity shares are excluded because with investment in equity shares, their change in values can be significant. The risk of change in value can be significant. But cash equivalent, it's expected that the risk of change in value will be insignificant. Okay. Cash flows, inflows and outflows of cash and cash equivalent. Important definitions here. Operating activities. Remember, we are to present statement of cash flows under three headings. So operating activities, the principal revenue producing activities and other activities that are not investing or financing in nature. So every business is there for a purpose. A business may be set up to buy and sell bread, to buy and sell clothes, to manufacture and sell gas, and those then become your operating activities. So the incomes and expenses around those activities, your main operating activities, they fall under operating activities. Cash flows from those activities are presented under operating activities. And then where there is a transaction and you cannot describe it as investing activities and you cannot describe it as financing activities, the standard says report it under operating activities. That's why sometimes we have, um, let's say, extraordinary items like one-off profit on disposal, for example, um, insurance claims and stuff like that. They are not your day-to-day transactions. They are not really operating activities. Neither are they investing activities nor financing activities. So if they don't meet those criteria under investing and financing, then the standard allows that they are recognized under or presented under operating activities. Right. And remember, the operating activities may be reported either as direct method or indirect method. And a lot of the time, entities like to present in the indirect method where they take the profit and adjust it for non-cash items, deferrals and accruals of past or future operating cash receipts or payments, and items of income on or expenses associated with investing or financing inflows. So that's the indirect method, and that's what we often use, and that's what we are going to use. With the direct method, then they have to present major classes of gross cash receipts and gross cash payments. So you have cash sales from sales, cash from sales, cash paid to suppliers, cash paid to for expenses, cash paid to um, employees and stuff like that. So you have to determine the cash element of these activities and report them. But it exposes the entity. It's become an easy way for competition to know the sources of cash flows, and entities don't like to be so exposed. So they prefer the indirect method. Remember, it's about operating activities. It could be direct or indirect. Now, when it comes to presentation in IAS 7, we have said it in clear terms that there are three headings under which to present: operating, investing, and financing. However, there are items that can fall under any of these headings. So you can interest, dividend received and paid. Interest or dividend received and paid may be classified as operating or investing or financing. So that is an inconsistency in the standard. The standard allows the entity to present interest received, interest paid, dividend received, dividend paid under any of the three headings. And so sometimes if one entity is presenting interest received under operating, another entity can be presenting the same under investing, and the point is the standard allows it. So it's one of the criticism of IAS 7 to have allowed these kind of inconsistencies, and therefore it makes comparison difficult if the entities choose to present these items under different headings. And so for the sake of consistency, us as a class, for us as a class, as we go through IAS 7 presentation, our rule, all of us, when you are dealing with interest and dividend received, classify it as investing. So you put it under investing activities. Interest and dividend received. Interest paid, tax paid, you classify under operating um, activities, and you must disclose them separately. They must stand on their own. And then dividend paid. If you pay dividend, if the entity pay dividend, it should be recorded under financing. So as a class, that's what we do. It means if you were reading any manual and it is presented differently, it is not a problem. You just have to know that for the sake of all of us in the class being on the same page, this is what we agree to do. So take note of that. All right. Now, this is how operating activities under direct method will look. Cash receipts from customers, paid to suppliers, paid to employees, pay for other operating expenses. And for these figures, for you to get these figures, you need to prepare control accounts. You need to prepare control accounts. So the control accounts, then from the control accounts, you are able to uh, get these figures. But like I said, a lot of entities don't really like the direct method. So we often make do with the indirect. We make do with the indirect. And so this is how the indirect method will also look like. We start with profit before interest and tax. The important thing is to look at the question and find out what you've been provided with in the question. Profit before interest and tax, or profit before uh, tax. So you must always know the figure you are starting with. Then you add back depreciation, and because we are dealing with consolidation, it means amortization of goodwill as well. And these and other items will be described as non-cash. So you have to adjust all non-cash. Profit has non-cash items. Profit use estimations, calculates depreciation, provisions, and all that are non-cash in nature. Your whole idea for statement of cash flow is to extract cash out of profit or loss. Is to extract cash out of profit or loss. So you adjust for non-cash, adjust for movement in working capital through inventory, receivable, and payable. And then you indicate the interest paid and then tax paid. Like I indicated, these must be shown on the face of the statement. They must be shown on the face of the statement, and that should give you your net cash from operating activities, right? Your disclosures. IAS 7 has disclosures. You want to look at them. So a quick summary before we go into the consolidation part of IAS 7. Remember to present statement of cash flows under 3 headings: operating, investing, and financing. Now, for operating activities, is either direct or indirect. Specifically for indirect method, take note of the starting point. You may be starting from profit before interest and tax, or profit before tax, and everything depends on the information available to you in the question. Remember to adjust for non-cash items and changes in working capital. Remember, interest and tax must be shown on the face of the statement. I've said all this, I'm just summarizing. Always think through whether it is a cash inflow or outflow. Inflows increase cash, outflows reduce cash. Now read on advantages and disadvantages of preparing statement of cash flows and analysis of statement of cash flows. Cash flows can be interpreted. They have meanings. So when you read on them, what does it mean? Having a net cash inflow or a net cash outflow, what is the implication for the entity? Now let's go into consolidation. This is the focus of our lesson, consolidated statement of cash flow. Now, everything you know about cash flow still stands with addition. So The consolidated statement of cash flow explains movement in a group's cash and cash equivalent and cash flows between a group and a third party. So it's about movement in the group's cash and cash equivalent and cash flows between a group and third party. It is prepared from consolidated financial statements. So it means all intra-group adjustments would have been eliminated, all corrections would have been done. You'll be holding a consolidated statement of financial position, a consolidated statement of comprehensive income, and you use that to prepare your consolidated statement of cash flow. So nobody is going to ask you to first of all prepare consolidated profit or loss, prepare consolidated statement of financial position before you prepare the consolidated cash flow. No, we have learned how to prepare consolidated financial statements. So you will have a consolidated financial statement, and you now have to use that consolidated financial statement to prepare consolidated statement of cash flow. Follow same principle. When you are preparing consolidated cash flow, it follows the same principles of IAS 7 plus other issues specific to consolidation. Like I said, when you are doing adjustment for non-cash items, then you have to deal with goodwill and its amortization. You add back goodwill and you will also add back any impairment, not amortization, impairment, sorry. Goodwill and its impairment, you deal with that in the statement of cash flow. Then acquisitions and disposal of subsidiaries. Acquisition and disposal, you determine the cash from acquisition and the cash from disposal. So you have some adjustment to make. Acquisition will bring in assets and liabilities, payables, receivable, um, inventory. And disposal of subsidiaries will take out assets and liabilities. Then your NCI, how much has been paid to NCI in terms of cash, and your investment in associates, how much are you getting from your investment in an associate. So these are peculiar to consolidation, so we have to talk about them. So you should deal with cash flows external to the group. Any intra-group cash inflows must be eliminated. Now, the other issues, like I said, is the dividend paid to NCI. So you have to learn how to get the dividend paid to NCI. Dividend received from associates and joint ventures. Acquisition and disposal of subsidiary, joint venture, or associates. Removing the group share of profit or loss of associates and joint venture. So these adjustments must be done. How do you get the cash element of investment in associates? How do you get the cash element in a joint venture? How do you get the cash element in NCI? That's what we are talking about. Then the effect of assets and liabilities of subsidiaries on working capital adjustments and cash flows, and impairment losses on goodwill. I've all mentioned this, though this is just to emphasize all these things. So as final word, every standard has disclosure requirement. You need to read the disclosures and to know how to prepare the notes to IAS 7. And there is always there is always the analysis bit on the statement, which means interpretation. And the way to overcome cash flow statement is not to run away from it, but rather to practice a lot of questions. Practice the same makes man perfect. So you take 2-3 questions, you practice it until it becomes a default for you. That's how you overcome the difficulties of preparing statement of cash flows. Read, and we'll meet and discuss further. Thank you.